Let's bring in former Boston Fed President Eric Rosengren. Eric, don't worry. You can smile. We're not going to ask you about drones in New Jersey. But on a just as hot topic for CNBC, if you were still at the Federal Reserve, why would you vote no on another rate cut?
Well, Brian, as you said, I think they will be cutting by 25 basis points. But the reason I would not is really threefold. First, the core inflation, whether you measure it by the PCE inflation or the CPI inflation, has leveled off over the last 6 months at levels well above 2%. The second reason would be with lower taxes, immigration and tariffs likely all to be inflationary. We don't know the magnitude of those changes. The policy hasn't been really enunciated very clearly yet. But the direction is certainly to make it more difficult to reach the 2% inflation target. And the third is that stock markets are ebullient right now, and monetary policy may not be as restrictive as the Fed believes. So even though real interest rates are relatively high by historical standards, which is one of the reasons why they've been lowering rates recently, and the fact that inflation has come down, they don't want inflation to level off at this level. They want inflation to level off at 2%.
As I posted to the Twitter or the X recently, Eric, the bond market seems to be telling a totally different story, because when the Federal Reserve cut rates back in September, you're looking at like a 3.7 10-year. Now we're like, what, 4.3? The bond market is going in one direction while the Fed appears to be going in a different direction. What is the disconnect?
So I think there are a couple factors with the bond market. One is I think that they're not as optimistic about how much easing is going to occur next year as a result of the likely fiscal actions that are going to be taken by the new administration. And the second is they are concerned that it actually will lead to potentially higher inflation, which would mean both that the Fed potentially would not be easing as much as they were expecting, and obviously bond prices move in the wrong direction when inflation picks up. So I think that's the reason that you're seeing different movements in the Treasury market.
Yeah, 4.4 on the 10-year. What would it take for the Federal Reserve to stop cutting? I'm trying to figure out what's going on, Eric, because all we hear about is how strong the economy is. Then we have these huge revisions down in payrolls. I travel the country. People just are not as optimistic as people in D.C. or maybe Boston and New York. I'm sorry, they're not. What's it going to take for the Federal Reserve to maybe say, we're going to stop, or we were wrong?
Well, I think it's quite likely at the press conference, if not in the statement, that they'll be announcing that because core inflation has leveled off, they're planning on pausing interest rate cuts until they see further progress in that direction. So while I don't think they'll announce that they've stopped, I think they will announce they're pausing, and it could be a long pause if we actually do have a pickup in inflation.
I mean, the dirty secret is that 10-year bond yields have been at the same level. I mean, if you traded them, they've been up and down, but 4.4 is basically where they were in September of 2023. They haven't moved a lot in a year and 3 months. On a macro level, Eric, again, what would it take for them to move? Would it be a meaningful change in some kind of inflation and or jobs data?
Well, if you think that the inflation rate is going to level off at 2% relatively quickly, then the bond rate that we're currently seeing is a pretty good return. But if you're worried that inflation's not going to drop down to the 2% inflation target, then you're worried that the Fed will not be easing as much and inflation may not be coming down as quickly. So I think we need to see more signs that that core inflation rate is starting to decline. And part of that is shelter, but some of it is transportation, some of it's medical. Basically, the service side of the economy is not still having prices increase at a rate that is not consistent with a 2% inflation target.